If you're starting a business or restructuring one of the biggest decisions you'll face is how to structure it for taxes. Today, we're breaking down two of the most common choices, the C corporation and the LLC taxed as a partnership. What they are, how they're taxed differently, and which one might make more sense for your situation. A C-Corp is its own tax-paying entity. It files its own tax return and pays corporate income tax, currently a flat 21% federal rate. Then, when the company pays dividends to shareholders, those shareholders pay tax again on that income. This is what's called double taxation. But here's the thing. If you're planning to reinvest profits back into the business, that second layer of tax may never come. The money stays in the company and compounds at the corporate level. An LLC taxed as a partnership, also called a pass-through entity, doesn't pay tax at the entity level. Instead, profits and losses flow directly to the owner's personal tax returns. So if the LLC makes $200,000, that income shows up on your 1040 and you pay tax at your individual rate. The big advantage here is there's only one layer of tax. The downside? If your personal income is high, you might be pushing that business income into the 32, 35, or even 37% bracket. Let's look at a few key areas side by side. In an LLC partnership, active partners generally owe self-employment tax on their share of profits. That's 15.3% on the first roughly $170,000 and 2.9% above that. In a C-Corp, owner-employees pay payroll taxes only on their W-2 salary, not on dividends. Pass-through owners may also be able to deduct up to 20% of qualified business income under Section 199A, but this phases out for high earners in service businesses. C-Corp don't get this deduction. Here's the bottom line. If you're building a fast-growing technology company, you almost certainly want to be a C-Corp from day one. The reason comes down to Section 1202 of the tax code, also known as Qualified Small Business Stock, or QSBS. If your company qualifies, founders and early investors may be able to exclude up to 100% of their capital gains on exit, potentially tens of millions of dollars in tax savings. But QSBS only applies to C-Corp. An LLC taxed as a partnership doesn't qualify, full stop. So if your goal is to build, scale, and eventually sell a high-growth tech company, the C-Corp structure isn't just a preference, it's the right call. For everyone else, service businesses, real estate, professional practices, businesses where profits get distributed annually, an LLC taxed as a partnership often makes more sense. You get simplicity, a single layer of tax, and flexibility in how you split income among owners. The right answer really depends on your specific situation, your income, your growth plans, and your exit strategy. If you want help figuring out which structure makes sense for your business, reach out to us. And if you found this helpful, check out our other videos on QSBS, 83B elections, and pass-through entity taxes. See you next time.